Hello and welcome to Livewire Markets Fund in Focus. My name is Chris Conway. Following the success of the Realm Dominion Income Trust and Dominion Income Notes 1, Realm Investment House has launched a new structured note strategy focused on bank capital and corporate credit. With a target duration of around 3.5 years and a built-in first loss buffer, the strategy aims to deliver attractive income while sitting higher in the capital structure than equity. To discuss it more, I'm joined by Andrew Papagiorgio from Realm Investment House. Andrew, it's great to see you again.
Thanks, Chris. Great to see you also.
What's innovative, Andrew, about the Dominion Income Notes 2, and what problem are you really trying to solve for investors?
Well, the Dominion program overall is a reasonably innovative product in its own right, and the second note series, of course, follows on from DMNHB and of course also DN1, which was a security we issued back in February of last year. So we've done these a couple of times. In the first instance, the big idea was finding a way to build a level of alignment and answer a few of the objections that we felt had arisen on the back of the traditional lit structure. So I guess we opined over how do we deal with the question of large discounts to net tangible asset value? How do we deal with the question around providing a level of certainty to the underlying investor? And that's where we settled on this whole note structure or portfolio note structure, which I guess we brought to market in the first instance. We were the first to issue these instruments on the ASX, and from DN1, we of course went to DMNHB, which is a pure note as opposed to a listed investment trust, and now we have DMNHB. What's innovative around DMNHB, really what we've done differently this time is just the term. So we've issued a security where we intend to call the security in year 3.5 from issue with a final legal maturity of 4.5 years. So DMNHB was issued for a longer period of time. It was issued for 6 years with a non-call 7.5 final legal maturity. The case of DN1, it was 5 years with a 6-year final legal maturity. This security is shorter. So what are we trying to do? Well, I guess what we're trying to do is build a level of term premium within the security. We're trying to give people what we think they want, which is a security with a shorter, nearer term maturity or call date. What we hope it achieves, and they say hope is not a strategy, so maybe it's more than hope. What we intend that our actions drive is an appreciation and an understanding of the fact that these securities will call and will mature. To some degree, we feel like it's not currently overly appreciated, the fact that, come the call date, we are incentivized to call these securities, and if we don't, they will step up by 1%. And then if they don't actually mature at the end of that year 4.5, what you have is a default event. Yeah. So it's not like these securities then go pushing into the never. And I think for investors here in Australia that had had some experience with hybrids in the past where they wouldn't call, they'd all of a sudden become these perpetual securities that you were stuck with forever. That's not the case with these securities. If you don't get your money back on the final legal maturity date, effectively there would need to be a workout, right? Which is something that, again, needs to be appreciated. And then you have all the other benefits that you had under the other securities as well. You have a very healthy equity buffer that sits underneath you, taking all damage first and protecting your exposure to the notes. So well buttressed, supported, an alignment there because we have to lose a lot of money first before unit holders are touched as well. And then we've got this shorter term. So, it's our expectation that once people have that initial experience of getting their money back, immediately we think it changes the colour and the understanding of those securities as well. So, it's not absolutely in our interest because getting things listed on the ASX is hard work and it's expensive. So generally what you want to do is you want to spread that cost over a longer period, which is why lit's such good business. And why, generally you want to be able to amortise the, 1 or 2% selling expenses over as long a period as you can. So, what we've decided is that we'll eat that. We'll take a shorter amortisation period over those expenses with the view that we prove the efficacy of the security and of the structure, which I think, frankly, will benefit us, but we think, unfortunately or fortunately, will benefit others as well that have issued in note form.
Andrew, just to follow up there, if I may, talk to me about the demand. So obviously you had the trust first, the first Dominion note, and obviously now launching this second one. And you were talking there about the expectation that people will understand the efficacy of the product. Are you hoping that once it does mature that there might be another opportunity for them to roll into a third or a fourth node? Is that sort of way you're thinking about this longer term?
In a perfect world, depending on market conditions,
Yep.
we want to be programmatic here.
Yeah.
We've been very open about that from the start, and that's why the platform is important. You know, so it's not just individual securities that matter, because ultimately we think this is a good way to build alignment between end investors and a portfolio of assets, providing a level of certainty. You know, certainly it's our objective to come back again and again. You know, so you need to build confidence, you need to build trust. I think the assets they're simple enough in the fact that they are a note structure, but there are elements to it that I think you know, we need to work at helping build that understanding around. One is the fact that it's not a listed investment trust. It will mature. Okay, you will get your money back at that stage, all things being equal and all assets being fine. You will be protected by our capital and you will receive that coupon. You know, so they are the key fundamental differences versus your perpetual listed investment trusts that I'm not sure are absolutely appreciated. And then, you know, even the benefit of that equity and capital buffer, you know, the question is, does the market fully appreciate that also? Because, you know, when we look at the market right now, I think ourselves and Challenger are probably the two that have gone out on a limb and articulated a 6% capital buffer under the Dominion series, which is higher than all other peers. Our actual capital level is above that number by a material figure also, and we publish that figure on a monthly basis also. So, you know, I think our expectation and hope is that, you know, a level of understanding building will help give people a better sense of the actual quality of what it is they're buying and a level of comfort within that as well, which, as you said, will allow us to continue to come to market.
Yep. Andrew, let's dive in a little bit to that level of comfort and understanding. So you're not simply buying senior bank bonds. Walk us through where you typically sit in the capital structure and why that matters for investors.
In the first instance, we are paying investors a certain rate of return, which, you know, in the case of DMNHB will be 3.15% above the 30-day bill rate. Okay, so, you know, clearly we're going to use that money to invest in other assets where we can benefit from an arbitrage or a difference between the stuff we buy and what we pay out. Now, offsetting that is the fact that we have a material amount of money that sits underneath the notes. You know, so at last reporting date, as at the end of January, for example, that figure was somewhere closer to 9%. So if we think about this Dominion structure post this new issue, you know, you could have the better part of $50 to $60 million sitting underneath you that has to go to zero for you to get touched.
Yeah.
Okay, and I think that's
that buffer.
That's the buffer, right? So I think that's a very important thing to understand, because a natural question would be, well, what stops you from taking as much risk as you want, okay, and benefiting off the fact to get all the upside? You know, so the portfolio will be targeted at an average weighted credit rating of BBB to BBB minus. It can go as low as BB, but it's our intention to keep it around that rate. Now, for us to be able to achieve the rate of return, we need to deliver that arbitrage or that benefit to us. The assets that we invest in are primarily asset-backed securities that are private in nature. And that's one of the areas where we have a core specialisation. We are one of the larger, if not the largest, mezzanine financiers of the Australian mortgage and auto market here in Australia, and are also active overseas in the same space. You know, so we are funding pools of home loans, pools of auto loans, and so forth, and we are banking the largest and most prominent non-bank lenders in this country, and some of the regional banks as well, in effectively providing finance to everyday Australians for what are reasonably vanilla type lending products.
Andrew, you've talked about the 3.5-year duration. Does it at all affect how much risk you're willing to take, reshape the way that you think about the investments that you make?
Well, the biggest thing when you play with term is really how you meet your asset liability mix, you know, and I think it's topical conversation right now with everything that's in the news around Blue Owl, for example, and there are a lot of very reasonable questions being asked around how private credit funds itself and whether these material mismatches between asset and liabilities is something that's understood well enough by the market. One of the really good things about these facilities that we invest in is generally they have a natural life of around 12 to 18 months is their weighted average life. So effectively what we've got in the case of the portfolio that underpins our first note, and again, this is something that we disclose, is around 18 months. The maturity of that note is effectively six and a bit years. Okay, so we're going to have to reinvest that money on 1, 2, 3, 4, 5 occasions. In the case of this note here, even though it's shorter, we're still going to have to roll the assets that underlie it. Okay, and these are all the same assets across both vehicles. You're going to have to roll those assets on a number of occasions. So when you're thinking about it from an asset liability matching side, it's not a case of, hey, I've got a 3.5-year note. I need to find a 3.5-year loan to put against it. What we've got is we've got these 1.5-year notes that we are effectively going to have to roll twice. As we get closer to that 3.5-year term, and again, it's more about liquidity management here than asset quality, then you're thinking about how you're going to meet the call. Okay, if we don't meet the call, the note steps up by 1%. So we're going to use that if we responsibly should to preserve value. Okay, but outside of that, our intention would be, and that's the reason you have a call date there, our intention would be to meet the call. So as we're going nearer to call, effectively you're assessing the market environment. You're taking a view on whether you believe you can roll it over into another deal, in which case it's pretty easy. One simply washes out to the other. If you don't think you can, well, then you start to roll the portfolio down, or you reallocate assets across your funds management platform as it makes sense, assuming that it's in the interests of those other funds to take those assets, right? And being a firm with approximately $12 billion in assets under management, we're in a pretty strong position that if we like those assets, we probably don't want to see them go away. If we can't, though, for whatever reason, we can run them down, because usually you've got the better part of 20% of these warehouses coming due every quarter. So as we're getting close to D-Day, if we're sitting in an environment that's completely uncertain, we've got a low confidence in our ability to roll the deal, and we've got a low confidence in our ability to absorb the assets, well, then we'd effectively put them into runoff, right? Worst case scenario, we switch and we take an extra year and we pay the unit holders 1%, right, as we amortise it down, right? And we are allowed to amortise it and pay it down gradually. And then that final end date is a legal maturity, a final legal maturity, where we have to make that note good by that date.
Andrew, you've talked about a lot of the buffers and the protections that are built in, and even then talking about how you can shift capital between public and private. Are there any other risks that you think are important for investors to understand that we haven't discussed so far?
I think ultimately the one thing to understand is that once it's a note and it's trading, it is subject to market forces, right? So it is listed on the ASX. If there are more sellers than buyers, it moves it. The fundamental quality of it can be fantastic, it can be good, it can be great, it can be terrible. Sometimes the price reflects that, sometimes it really doesn't. And I think from our perspective, there have been learnings in that as well. I think the DMNHB security at the moment sits underneath $100. I think part of that is just because the market is wider, and because these are notes, when credit spreads widen, the value of these securities will decrease. Okay, so if the market, when we issued DMNHB, for example, we issued it at a 300 over spread. We came wide of the issuer that had come to us, that had come to market previously. We came 25 wider, so they came at 275 over, which was Challenger. We came at 300 over for a portfolio that we felt was pretty much in line, if not slightly better on rating. That's of course our view, and we felt we had priced it at a level where it would have performed better than it has, frankly. And part of that is because that market has widened overall. I think market just a bit more softer, which means the spread has to move. But also, some of the behaviours in terms of the selling pressure on the notes as a lot of new issues hit the market in a short period of time seem to sort of exacerbate that as well. So, I think it's interesting because we would look at it and say, from a underlying quality standpoint, in terms of how the underlying portfolio is performing, where the equity sits, the portfolio looks in very good shape. But it's not necessarily reflected by the day-to-day machinations of price, And equally, the other side of that is true as well, So in the case of DN1, for the majority of time, it is traded above par or above that $100 level. And certainly it's our hope with DMNHB, there's that word again, certainly it's our expectation, I should say, by pricing this security appropriately and bringing term into the conversation, that we put the note in a better position to perform. And that also, what's incumbent upon us in all of that as well is also to pick partners well. Pick the sales teams that are going to honour the security, that are going to hold it and really want it. You do sometimes get a little annoyed as an issuer when your security looks like it's being used as a funding source for new things coming through, especially when you've just issued it a month or so ago. So I think it's incumbent upon us to protect the note holders by bringing the right partners into the selling of the note, making sure that it's ending up with people that really want it and want to hold it. That's an element that's become more important as we have more to do with the ASX as an issuer as well, right?
Yeah, absolutely. Andrew, a couple of functional questions to finish off. Not asking for you to provide personal advice by any stretch, but for the clients that you have, what role does the fund or the notes play in the portfolio?
It's not one size fits all. Every client will have a different set of needs. They will have their own risk tolerance. I think it's been important to us as a business to build choice for the financial advisory community, where we've given them what we believe to be a real high quality private strategy that has a good level of asset liability matching and is quite accessible. We have our Realm High Income Fund and Global High Income Funds, which are very active daily unit price funds, which enjoy very high turnover, where we take a very active view around market, and they've performed very well versus peers over the long term. And then we have our Realm Short Term Income Fund, which effectively looks to deliver a return of around 100, 150 odd above the cash rate after fees. And that again is at the higher grade part of that credit spectrum. And very often there's not a lot of crossover between the pools as well, right? The stuff that you own in strategic, you don't tend to own it within the other funds either. So different stakeholders that are sort of running them and pointing them internally, different people having different meetings with different advisors depending on where their palette sits. So, I think from our client perspective, we would never shove it down our client's throat. I think, interestingly, when we thought of bringing the note, it was more about engaging with a part of the advisory market that we hadn't really had a lot to do with up until that point, rather than really being something where we're looking to jawbone our existing clients into it. That being said, our existing clients I believe to be advocates of us and believers in us, and when the price does move around, it'd be nice to see them get active occasionally, but they need to do their own work on that.
Andrew, perhaps the most important question, where can investors find out more?
Well, the transaction launches on Wednesday the 11th of March. They need to find out about it from their financial advisor, who is always the best person to speak to on these things, because goodness knows people are inundated otherwise. And I think importantly, as a business, we've always been very focused on the intermediation aspect that financial advisors provide and the assistance they provide in clients as well. So definitely speak to your financial advisor, but intention at this stage is for the deal to launch on the 11th of March.
Andrew, it's always a pleasure. Thanks for taking us through that.
Thanks, Chris.
If you enjoyed that conversation, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.